You listening to Trigger Seattle podcast.
I'm so excited about 2021, and we're right now in a new year, and I have a special guest today, Jim Murphy with Caliber Home Loans.
Thank you for having me. First of all, Oleg, this is fun.
As the rates is very, very low right now, and what that leads to for prices to increase. I just listened to Matthew Gardner today, and in the United States, prices increased for about 7%. But in our area, for example, in Kirkland, prices increased for about 14%. And that leads to the question from many buyers if housing market going to be affordable or not.
That's a great question that everybody has, and Matthew Gardner does talk a lot about home prices going up about 7 or so percent, but you don't have to have incomes go up by that much as well to be able to cover those home prices. And when you multiply that by rates, as you stated below, going down underneath 3% year over year from Q4 2019 to Q4 2020, you add an affordability mix there that the media doesn't talk too much about on what the actual monthly payments look like. Because if you have an increase in home price, but a decrease in interest rate, you actually will have more affordability the following year.
Most schools, they doesn't teach finances,
right,
and people not understand how interest rate relate to the price and mortgage payments, monthly payments. And I hope you can explain today and explain more details how that's going to be related.
Absolutely. I brought a presentation for that. We can run through those things as well. But basically, if you look at really easy numbers, like a 5% increase in price, if you have a 5% increase in price, you basically need a 1 to 2% increase in income to cover that gap.
We're right now in January, and in general, I understand, interest rate going to be depends on the credit score, on financial situation of a specific person, but in general speaking, if person have a great credit score, what's the rates today in January?
In general, you're looking at a high 2%. And that is historic lows, as we've seen all across the media. About 2.75 was the average towards the end of Q4. The average in 2019 was about 3.74, so almost 1 full percent lower. And when you have that big of a dip, you do see affordability go up.
Yeah.
An increase in buyer pool goes the same way that the increase in price would. Because if now you have 10% more buying power, then you can actually afford 10% greater house. So if you look at Kirkland last year buying $1 million property for the same price, this year you could buy $1 million property. So
it's going to be the same payment.
Same payment, exactly.
Myself, I'm a real estate broker, and I checked prices today because data are available for months of December. And medium sale price for residential market for East Side right now, $1,113,000, and for Seattle, for residential housing market, about $800,000 on today's market. And this is very high price tag for the properties. And you mentioned people can afford them to buy. It doesn't really matter if prices increase even for $100,000 if interest rate lower almost for 1%, or I think probably even 2% comparable to a couple of years ago.
Yeah, absolutely. So there's a lot of different factors here. So if looking strictly at interest rate, you can afford that 10% higher in house for the same monthly payment if your income didn't move at all. But if your income does move with the lowering of rates, then the increase in price doesn't really impact you so much because that payment is going to be the same. The other thing that gets factored in too, when you have a median home price around Seattle in the mid 800s, say you have a 15 to 20% down buyer, that is now a conventional high balance loan because you have different types of loans that have different types of qualifications. So jumbo loans are a little more challenging to qualify for. You need to have longer trade line history. You need to have a longer work history. Sometimes you need to have 2 or 3 different trade lines that you've had for more than 24 months. Sometimes you need a higher down payment, higher credit score. Those risk layers just get a little bit higher when you're looking at jumbo financing, but conventional is a little bit more simple. They allow for higher debt to income ratios. They allow for lower credit scores, lower down payments. And King County just increased their high balance loan limit to $776,250, which was almost a $35,000 increase, which that alone helps people afford maybe a 1 to 2% increase in price just by the county loan limit going up.
That's very interesting.
Buyer pool actually just shifted up strictly because of what Fannie Mae and Freddie Mac did on a county by county basis.
That's probably what's happening right now because we have a lot of demand on the housing market and multiple offer situation pretty much everywhere. I sold house in Stanwood. We had 5 offers. and I sold house in Auburn. We have 4 offers, and like anywhere I listed property right now, we have like multiple offer situation. And in some areas, agents receive up to 20 offers on one listings. And that's probably creates huge demand because buyers try to use this momentum to buy property to secure future. Housing market going to be increased, I believe. I'm broker for 20 years. I went through a couple different recessions and went through a couple different waves. And what I see myself, I did not see it before. When you buy property and you invest as a long-term investments, the property, if you purchase property in good location, usually double in the price within about 9 to 10 years if we buy it in good locations. This makes such a great investment because you first of all live in a house, secondly your property appreciate and you instantly build equity in the property which you can use in the future, and plus your property really good protection from inflation. Everybody worry about distribution of vaccine, and with COVID time, if people will afraid to take vaccine market, probably maybe going down stock. I'm talking about stock market.
Yeah.
But it depends. Like we'll see what's going to be happen with this distribution in a couple of months. But real estate, it's really safe security, safe investments, and real estate it's really tangible because you cannot replace so fast, so quickly. You cannot build house overnight.
Well, and especially in an area like this. If you're looking in the Puget Sound, you're surrounded by water and mountains, right? You have a very limited map that you can actually build properties. So if you do buy something that's near some sort of city center or some place of work or even some place with acreage that ultimately will push more and more people out to, then yeah, your land absolutely becomes more valuable. And we saw that with COVID, right? We saw a lot of people move to different areas where maybe they commute less, maybe 1 or 2 days a week, maybe they work from home primarily, and those areas got stretched a little bit.
Yeah.
So when those areas get stretched a little bit, you see multiple offers in greater zones, like north and east and south. But even around the city centers, we've seen multiple offers on just about everything. We're seeing 4 to 10% increases on just about everything right now.
Can you run a couple scenarios, for example? Like example, if you buy the house for this specific amount of money or this one, what will be your mortgage payment with different interest rate? We'll put for you guys on the screen this information, but Jim gonna go through the information right now.
Yeah. For now, these are going to be pretty general, so we can look at it from a baseline. But of course, these can be extrapolated to any purchase, right? The affordability myth right now is that housing is not affordable, right? And that's what we've kind of talked about originally, but that is because we're looking at the wrong metrics. Right now, when we have low interest rates and we have higher home prices and we have increases in income at the same time, if we look at this model, our affordability index is about the best as it's ever been here in 2020.
So it's like comparable to what? To
2010, 2011, 2012, 2013.
That was the best years to buy property.
Correct. Exactly. Wow. And then 2014, 15, about the same as well. And that's when we had another low interest rate environment. So if you looked at an average principal and interest payment for somebody across the entire United States, it was about $1,000 a month for principal and interest. That income is based off of $5,000 a month. If you make $5,000, you should be able to afford about a $1,000 a month principal and interest payment.
Yes.
You have a 5% increase in rise in price.
Okay.
That takes your principal and interest to about $1,050. Now, the fear is that you would then need to have a 5% rise in your income to be able to afford a 5% rise in your monthly payment, right? That's the general thought, and that's what the media likes to push.
Yeah.
So technically, if you needed to hold $50 more a month in income to cover that $50 a month rise in price, what is that percentage? It's only 1% because you're not using all of your income on your house. You're using a percentage. So in this percent, we're using 20%. But even if we used 30% of an income, you'd still be able to afford a 5% rise in price with a 1% rise in income because we're not using all of that. And debt to income ratios are usually on housing somewhere between about 20 and 40%. So even if we have, a 2 to 1 or 3 to 1 rise in price versus rise in income, you can still afford that. And that's what we saw this last year. We saw incomes go up by about 5% year over year, which would then allow for maybe a 15% rise in house prices.
Okay.
And still be able to afford that. And that takes your Kirkland example.
Yeah, that's very interesting. And with mortgage securities, when you buy property and you secure a mortgage for 30 years, I think it's like almost unbelievable investments because we have inflation like rate from like about between 2 and 3%.
Yeah.
Depends on different years. And basically you beat the inflation with purchasing of the house.
Tax time too, right? When you're paying interest on a primary residence, you can write that off on the tax return because you're a property owner. So you also get that additional benefit of being a property owner as well. And when you're talking about rental increases, you're absolutely right. Your rent's going up for the same property that you're living in. You're not getting any benefits for that. One on the flip side is if you're staying in a property, and on average, we'd say over Puget Sound in the last 30 years, it's about a 4.9% increase in appreciation.
Yeah.
So instead of increasing your rent payment, you're actually increasing your asset at the same time while getting tax benefits, while you get none of that during rent. Of course, paying $4,000 or $5,000 a month for a mortgage would be a lot different than paying $2,000 for a rental somewhere in Seattle, but there is a happy medium there that I think folks forget because you do get those tax breaks which give you money back in your pocket at the end of the year.
Makes sense.
Let's hop over this next one. So when we're looking at Q4 purchases in 2020, let's use an average of about $350,000.
Okay.
That's a 7% home price appreciation year over year. We've talked about that number nationally. That's a difference of about $22,900. So in our example here, if you purchase a house for $327,000 in 2019, which obviously is not local, but this is a good math number, and it increased to $350,000 in 2020, of course you'd say, well, I should have bought in 2019 instead of 2020. It's too expensive. And that's what the media is going to tell you.
Yeah.
What the loan amount would be is if you put 10% down on either of these two loans, you're looking at $294,000 or $315,000. That's 10% of the purchase prices between 19 and 20. That change is $20,600.
Wow.
And again, you're like, wow, that's too much money. That's a difference that I don't have. Interest rates at that time, 3.75 in 2019.
Okay.
2.75 in 2020. What is that on a principal and interest payment? $1,363 versus $1,286. You're actually paying less money on more borrowed a year later, even though you spent more money on the house.
That's very interesting.
We have to unpack this a little bit further because you have mortgage insurance with less than 20% down on a purchase. Yes, that is going to be higher with a higher loan amount. Now, this is with good credit, and we understand that different loan programs and different people might have slightly different numbers in these, but this is an example we can use. That change is $8 a month. So even mortgage insurance change between about $20,000 is not a great monthly change. Still net $69 less in 2020 Q4 than in 2019 based on a depreciation, or excuse me, on a lower interest rate. Plus, you would look at a depreciation at 7%. On a down payment, yes, we are absolutely looking at more, right? Looking at about $2,290 more.
Because higher price for the property.
Higher price for property means a higher down payment. If you looked at it a different way and you tried to finance that, you can in some ways. That's a little bit more in-depth conversation, but that's something you could look at too, which is about $10 a month.
Yeah.
Which means about $2,290 is $10 a month in financing. Easy offhand math, $10,000 a month in increase is about $50 a month in monthly payment.
Yes.
Now look at our income, 5.9% increase. Now we have $5,295, only a $295 change. We are still winning on our monthly payment.
Yeah, that's great.
We're actually less than we were and making more money 1 year later in 2019 to 2020 based on averages of increase in property value and an increase in income.
That's very interesting. And thank you so much, Jim, for covering this and open up this conversation because nobody teaches in the schools or in the college. It's about affordability. Property is still affordable right now, even with prices increase. And if people have little increase in their income, that's totally affordable with very, very low interest rate.
The biggest change there, Oleg, I apologize to cut you off, but and again, it just goes back to your income does not have to increase as much as the home does. Yeah. It's a percentage. So even if it increases, call it like 0.2% as much as the home does, you still likely would qualify for the same amount a year later with that same 0.2% increase in income versus the change in price.
Yeah, I'm totally agree. What do you think about rates? What's going to happen with the rates in 2021?
I think there's going to be a small spike. I mean, the vaccine is now available. It is slower than we thought it was going to be. We do have some wild stuff going on right now, just geopolitically and internationally, economically, all of it. So it feels like there has to be a small spike. Rates have been incredibly low for basically since April of last year. And when you have rates that low for that long, you feel like there's got to be some movement up. But I think overall, 2021 is going to be a low interest rate environment. I think somewhere in the high 2s to mid 3s. I think there's about a 0.5% range there where they could fluctuate. But I also think it's going to be relatively short term. I think we'd probably go up for a little while. And I think we come back down when we realize the economy needs a lot more rebuilding. And I think the Fed is going to continue to help rates and keep money inexpensive so we can try to get folks to continue to make the economy go. Another big thing that happened this year was Janet Yellen, former vice and Fed chair, is now the Treasury Secretary. So if you have somebody that's been in that position before, now in the new Democratic office, then you probably have a pretty good line between the Fed and the new presidential party. So I think that also helps keep money inexpensive as well.
That's very interesting.